All right. Well, I think we should get started. Michelle, are you ready?
Am ready, Amy.
Okay. I am Amy Brazil, and this is my business partner, Michelle Hulbert, and we are the Hulbert Brazil team. And also up at the top there is our loan officer assistant, Tiffany Faulkner, and she's helping us with the technical issues today. We are so happy that you've joined us. We are very firm believers that reverse mortgages are an amazing product and something that all seniors should know about, whether they think they need it or not. It is an excellent tool for retirement, and it's our mission to educate as many people as we can in regards to this program. A couple housekeeping things. If you have any questions, just type them in the chat. We'll try to answer as we go along, and we'll definitely have a Q&A at the end. Also, we are recording this, and so we can send it to you afterwards so that you can have it to review or pass on to any of your senior friends who you think might benefit from this webinar. I'm going to start off with a poll question, and I would love for everybody to vote. What is the number one retirement fear? Being bored, I might want to kill my spouse, running out of money, long-term care expenses. Okay, we got a couple people voting. Let's give it another 30 seconds here. Okay, so it is running out of money, and 50% of you got it right. All right, I have one other question for you. And let's see, let me find that one for you. And this one is, what can I use a reverse mortgage for? Supplement my monthly income, pay off an existing mortgage, a line of credit to use for whatever, a whirlwind trip to Europe, pay long-term care costs, or all of the above. Okay, you got a couple votes coming in. Okay, actually, the answer is all of the above. A reverse mortgage can help with all of these items, and we're going to talk about them in our presentation. I'm going to turn it over to Michelle, and we'll get going on things.
Thanks, Amy. I was really shocked that nobody put something that, wanting to kill their spouse. I guess everybody, is in bliss. That's great. So thank you so much for joining us today. One of the first things I want to point out is that you'll hear different terminology during the presentation today. Obviously, the slide shows flex payment mortgage, commonly known as the reverse mortgage. Guild has branded this program just a little bit differently, so I just want to point that out so there's no confusion. And then there's also some different components of this type of loan that we'll talk about in later slides. So I wanted to clear that up right away so there's no confusion as we go forward. There are approximately 77 million boomers in the US, with 10,000 turning 62 every day. That's a pretty remarkable number. Personally, I'm a Gen X. I'm just 1 year shy of being a baby boomer, but this is the biggest group there is. And that's the time when they're thinking about retiring and really starting to contemplate strategies that might exist for them to prolong their retirement. We're all living a little bit, longer these days. So one of the biggest fears in retirement is actually running out of money. This statistic is really based on household finances, based on debt, assets saved for retirement, and it's believed that 53% of households are at risk for not having enough savings to live up to their standards. So essentially, how they're used to living before they retire. When interviewed, only 24% of those interviewed felt optimistic that they had ample funds for retirement. That's kind of a scary low number. And their biggest worry, as far as expenses, healthcare costs. That was the number one, what weighed on their mind was the healthcare costs. So flex payment mortgages or the home equity conversion mortgage. Remember, I told you there were a few acronyms that we had to kind of get through here. The home equity conversion mortgage is a feature of the flex payment mortgage. And this feature of the mortgage can be a great way to extend the life of your retirement resources, such as your IRAs, 401ks, and savings. And we're going to dive deep into this, but I'm just trying to get you, acclimated to the terminology here. So what is a flex payment mortgage? It's a flex payment mortgage is an FHA insured loan that allows a homeowner to convert equity in their home to available cash that can be used for anything, and no monthly payment is ever required. A HECM, or home equity conversion mortgage, is a type of flex payment mortgage. So what are the requirements? You must be at least 62 years of age at closing. You must own the home and occupy it as your primary residence for the life of the loan. Be current on all property taxes, insurance, and HOA dues. Be counseled by a HUD-approved financial counselor. Borrowers are not required to make any mortgage payments, but they can if they wish, hence the flex payment mortgage. Also, the home must be an approved property according to FHA standards. And actually, Amy will get into the nitty-gritty details of that later in the presentation. So how do you access your flex payment mortgage funds, and what can they be used for? So taking them, out, whether it's a monthly payment, which is the term or tenure. And that's essentially where you set up a payment for life. And you can determine what that amount is as long as it, jives with the amount that's available on your flex payment mortgage. So if you want to set up a long-term payment for $1,500 per month, you can absolutely do that. A lump sum is an immediate cash payment. Our clients that take lump sum payments are either taking a lump sum to pay off an existing mortgage at the time of closing, or they're taking a draw because they have an immediate need for that money, such as a large home improvement, or they're, maybe they're funding some medical issues. Then you have a line of credit. This is where you keep the line of credit available and you draw on it as you need to draw on it. That can sit for a long time, or somebody could, take periodic draws. And this, again, as I mentioned, you can even make payments on this, but you never are obligated. One thing to remember is you only are allowed 60% of the flex payment mortgage for the first year. Basically, FHA has guidelines in place to where they want to make sure that the borrower is not taking all the money in the first year of the mortgage. The remaining funds are available in year 2. So flex payment mortgages are considered a financial tool, and housing equity is one of the major sources of wealth for many seniors today. There's an unprecedented amount of borrowers or homeowners who own their homes with very little mortgages or free and clear. So many financial planners are considering flex payment mortgages as tools to help seniors prepare for retirement. And one of the key components of this is they're trying to maximize their clients' investments for the long term. And in doing so, keeping them from maybe taking withdrawals out of an account that might create a capital gain. Because if you think about it, taking money from a 401k because you've been deferring taxes all these years on your 401k, that becomes, a taxable event. Taking money out of your stock funds also becomes a capital gains taxable event, whereas the money taken from a line of credit is not a taxable event. So these are really great charts that were created by Barry Sachs. And yes, we understand that this does go back, quite a long ways in time, but it does depict the time span of, let's say from a time a borrower actually would start taking, or a homeowner would actually start taking money out of their portfolio until they run out of money, which is depicted in the first chart there. So they run out of money. In this case, the chart is 1976. And then after that, they start taking a line of credit withdrawal until, basically 2002. But look at the difference and the strategies on the slide on the right. So this is a combination of taking money from the investment portfolio and then alternating withdrawals from their flex payment mortgage. So you can see that there's, several different withdrawals throughout the year that they're taking, specifically when market conditions may be such that they wouldn't want to take the money out of their investment portfolio. Maybe that would have created a large capital gain. Maybe the market was down significantly, or maybe the market was up significantly and their investment advisor wanted to keep that money invested over time. But if you look down at the bottom of that slide, there's a considerable difference in the money that's left over at the end of that time span versus just taking it strictly out of your stock portfolio. So I really would have you go back to this slide time and time again and see how alternating can really help you preserve your net worth over time. So let's talk about the flex payment mortgage compared to a conventional CD. So we went out and pulled current interest rates for a 1-year CD, which is 2.5%. Gosh, it seems like the last couple of years they've been a lot better than that, but with interest rates coming down, so have interest rates on CDs. So in 15 years, you would have 137,500 on 100,000 invested. That's assuming that's the same reinvestment rate over time. Well, if you had a flex payment mortgage line of credit for 100,000 at 6.25%, in 15 years, you would have a line of credit available in the amount of 255,000. And let me explain, because this does grow over time. So the HECM, or the home equity conversion mortgage piece of this, actually grows, and it's tied to an index called the constant maturity treasury. So essentially, this is an adjustable rate mortgage. So the constant maturity treasury plus the margin is what your interest rate will be. So that will fluctuate on a monthly basis, up or down, depending on what interest rates are doing. But if we took this 6.25% number, and again, in 15 years, you would have $255,000 available for your retirement versus the 137. All right, so maximizing asset growth using the flex payment mortgage line of credit. So if you look, the top graph is from the previous page. And then we also put in just another graph that kind of showed, somebody using, let's just say they had $10,000 in investable money. They own their house free and clear, but they have $10,000. They're going to put that in a CD. And over 15 years, at 2.5%, it's only going to be worth $15,000. Whereas they have a free and clear home. So they take out a HECM, or a flex payment mortgage line of credit. They have $180,000 of accessible line of credit that they can obtain. So keep in mind, this money is not, in this particular instance, this isn't meant to be touched. We've tucked this money away in the CD, and we're tucking this money away in the line of credit. Look what it's worth in 15 years. That homeowner has access to $459,000 in their line of credit that they can use for anything at that point in time. So one of the one of the big factors that our homeowners are really concerned with is because this conversation comes up often is, delaying taking Social Security. And we all know that you know, they can take a substantial penalty if they take Social Security at age 62 versus maybe age 68 or 70. So this is a strategy to help a homeowner bridge the gap. Let's say somebody either wants to retire early at 62 or maybe they have to retire early. This is an option for them to bridge the gap and not take and delay taking Social Security until a later time when they will have received the higher amount. So, this is a strategy that I think is brilliant, and a lot of clients are taking heed with this and using the reverse strategy from age 62 to either age 68 or 70. Another component and great feature of this program is exploring your legacy options, the giving while living, to witness the benefit of an inheritance while you're alive, right? Being able to enjoy the fact that you gifted a down payment to, let's say, your son or daughter, or you got to experience life events with friends and family instead of leaving, them monetary gifts. And then enjoying time with relatives using the payment proceeds. I was listening to a podcast this morning, and they titled it Reverse Vacation. And I thought, what? What's that? And this gentleman had taken out a reverse mortgage on his home. He paid off his monthly mortgage, and he had, let's say, a $3,000 a month mortgage payment. So he basically freed up 36,000 per year. He has 4 grown children and 8 grandchildren. And he said, I am going to take every dollar of that, and I'm going to take my family on a vacation every year. The only deal was is somebody else had to plan it, not him. So I just thought that was really a great strategy. Um, Another just quick story is I recently had a client that came in who wanted to fund her grandson's college. She had raised her grandson, and she lived on a fixed income, but she did have a substantial amount of equity in her home, and he wanted to go to college, and she knew it was going to cost about $150,000 over that time frame. And we were able to give her a reverse mortgage to be able to pay for that, again, with no monthly payment out of her pocket. So did you know, because most people don't, that a flex payment mortgage can be used to purchase a home? This is really one of those little kind of secrets about this particular program, is that, everybody thinks it's just to get the equity out of your house, and that's not true. We've had many clients that have been able to buy homes that basically allows them to retire in the home that fits their lifestyle, move to a more desirable climate, right size to a more suitable home, move closer to family and friends, or maybe even purchase the dream home that they always wanted. So in that case, maybe an upsize. So the benefits of purchasing with a flex mortgage are they can buy a new home with less money down compared to an all cash purchase, retain more liquid assets compared to an all cash purchase, because remember, they're not having to put all of that money into the transaction like they would if it were a cash deal. There's still no monthly payment required except for your property taxes, insurance. There's limited income and credit qualifications, meaning they don't have to meet the stringent criteria that you may have to on certain other types of loans. And they get the security of owning a home versus renting. So here's your typical purchase options when buying a home. You got a traditional mortgage, an all cash, and a flex payment mortgage. So just, a quick rundown of the pros and cons. The pros of getting a traditional mortgage: you have a lower down payment requirement. monthly principal payments reduce the mortgage balance, so you're actually gaining equity on an annual basis or a monthly basis. But some of the cons is the monthly mortgage payments could negatively impact a buyer's cash flow, especially as you're entering your retirement years. Most people don't want to increase their debt, they're trying to reduce their debt. And then to access the equity in the home, assuming that you pass away, your heirs must either sell or refinance. And just, what that means is if they're trying to get the the equity, the cash out of the house, they can't, they have to either refinance the loan or sell it. They can always keep the house and rent it and continue to make the payments. So I just wanted to make sure I touched on that. So an all cash deal, what are the pros? Obviously, you own the house free and clear. That's a great, we've been kind of indoctrinated that that's how it should be when you are retired, but maybe not. Cons, it ties up a large portion of your money. And the only way to access it once it's in there is taking out a cash out refinance or doing a home equity line of credit, which both have payments. So then you get to the flex payment mortgage. We have no mandatory monthly payment of principal and interest. And compared to all cash options, the buyer actually retains more liquid assets. So the cons on this option is the loan balance increases over time, assuming the buyer does not make a voluntary payment. Remember, I said you could always make a payment if you want, but if you don't, your interest is accumulating just like it would on a regular mortgage, except on a regular mortgage, you're paying it. On a reverse, you don't have to. And then your heirs must sell or refinance when they inherit the home, because the loan can only be the parties that were on the mortgage to begin with. And once those parties have passed away, then the heirs must sell or refinance. So let's look at a couple of quick strategies. So this is a borrower who wanted to downsize. They are tired of the older home. They wanted something new and in a 55 plus community. So they sold their home for $700,000. They had no lien on the property, so they owned it free and clear. It cost them about $56,000 to sell the home. So the 8% represents realtor charges and seller paid closing costs. So they walked away with $644,000. Well, their new purchase for the 55 plus or condo was a sales price of $625,000. And the transaction and miscellaneous expenses, which represents their closing costs, title and escrow fees, anything that basically comes with buying a home up front, comes up to about $19,000. So for a total of $644,000. They have no mortgage payment. They paid cash for the house, but they also don't have any money left. So is there a better strategy? So this particular client upgraded their home. They wanted to buy their dream home, and they were able to do so by using a flex payment mortgage. So you have a purchase price of $1 million. The gross flex payment mortgage approval was for $409,000. This is based on their age being 70 years old. So that's the maximum that they could qualify for based on their age. The loan and closing costs for this mortgage were $33,000. So that included the title and escrow and all the loan fees. So they had a remaining balance left at $376,000. So we took the cash that they had remaining. They remember they netted $644,000 from the sale of their home. They needed $624,000 to consummate this transaction and buy $1 million house. And if you look over on the right slide, they still got $20,000 to retain in their bank account. So they were able to upsize their home and get the home of their dreams without having a mortgage payment. So this is a client that wanted to downsize. This is that same 70-year-old client. They they have a purchase price of 500. Again, that gross flex payment mortgage approval of 205, less closing costs and expenses, leaving them 184,000 in the form of that mortgage. So look what was required. The borrower only had to come out of pocket with $316,000. That was the requirement based on this particular client's age, and they were able to purchase a $500,000 home with no mortgage payment. And look what they have left over, $328,000. So a lot of our clients are using this strategy. I recently closed a loan for a gentleman and his wife that were selling their home in Reno and moving to Texas. It was their goal to downsize and be closer to friends and family because they had lived there a long time ago. So they sold their home here in Reno for a little over 600,000. And one of the things that he stressed to me up front was he was kind of tired of being broke, like living paycheck to paycheck, not having a reasonable savings account in his own words. Like he said, I'm 75 years old. I should have some money in the bank, and that is my goal out of with trying to do this mortgage. So the home he bought in Texas was about 475,000. He was able to do a reverse mortgage, and he did owe some money on his house here in Reno, but with the reverse mortgage, he was able to retain about $130,000 from the sale of his home, which met his goal of having money in the bank and having no mortgage payment for the rest of his life. And he couldn't have been happier. So these are just some of the ways that a flex payment / reverse mortgage can help clients that are wanting to purchase, their whatever dream home, whatever you want to call it, in retirement, because some people's dream home is to downsize. So, and then with that, I'm going to turn it over to Amy. Keep in mind, we have the chat open. Please ask questions. We know that everybody has a different thought process on how this works. So put it in the chat and we'll get to those here shortly.
Okay, so we talked about how you can use a flex payment mortgage for retirement strategies. We talked about how you can use it to purchase, and now we're going to talk about how you can use it to refinance your home. You can enjoy the benefits of a flex payment mortgage and stay in your home or age in place with peace of mind. So let's say you have an existing mortgage on your house. In this slide scenario, the borrower is 70 years old, his home value is 600,000 and his current mortgage is 200,000. He wants to pay that off. He pulls out a flex payment mortgage funds of 222,000. That's what he qualifies based on his age, the interest rate, and the equity in his home. He uses 200 to pay off his current mortgage, now not having a monthly payment, has thus freed up that extra money each month, and he was still available to have $22,000 cash at closing. If you look at the graph, you can see that that loan balance of 222,000 is growing over time. That's the purple box. There is an interest rate that we talked about earlier, the variable interest rate that'll allow that mortgage to be delayed until such times as they pass or move out of the home. The dark blue is the perceived equity of the property, assuming approximately a 4% appreciation, which over the last 50 years is a very conservative appreciation rate. You can see that the value of the home is also growing. He's not in jeopardy of being upside down in this scenario. Let's say you own it free and clear. Same borrower, 70 years old, home value 600, but no mortgage. Now he just wants to pull some funds out. He's going to pull that same amount, 222,000, and he's going to take 75,000 right at the closing. Remember, we talked about seniors are limited on only taking 60% of the equity in that very first year. This is a protection measure put in place by FHA. That leaves him an initial line of credit of 147,000. If you look at the chart, that dark blue is the loan balance. He doesn't intend to touch this amount of money. He has it as a line of credit. He is going to allow it to grow over time with that interest rate. And then you can see the excuse me, you can see that it's growing slightly over time because he's not pulling any of the line of credit out of it. The purple shows the continued appreciation of his property, and the gray line is the line of credit growing with that interest rate that is on that mortgage. So, we had a client, her name was Kathy. She's this energetic 78-year-old who never plans to retire, and she is self-employed and was planning to expand her business and approached her bank for a HELOC, a home equity line of credit, and she didn't qualify. And like many self-employed borrowers during COVID, her income had dropped. And so on paper, she didn't qualify for the traditional bank loan, but she did qualify for a reverse mortgage. So she had a lot of equity in her home. We used the reverse mortgage not only to obtain a $300,000 line of credit for Kathy to actually grow her business, but she also paid off her existing home mortgage of $165,000, thus eliminating that monthly payment. The reverse mortgage worked for her because the requirements on income are not as strict as they are on a traditional mortgage. It was such a win for her. I mean, she just wanted to get a line of credit and was totally okay with making those payments. This allowed her to pay off her mortgage, free upping that amount of money, as well as opening that line of credit to use as needed over the next, hopefully 30 years of her remaining lifetime. Now, on this page, this is just to give you an idea of that line of credit. So it's just as an example, a 62-year-old borrower owns his property. It's worth $500,000, free and clear, pulled out his line of credit, approximately $168,000. And this shows you that at a 4% return, a 5% return, a 6% return over that time, if he just left it alone, potentially at the age of 80, that 168,000 could grow to 350 to 500,000. In which case, at that point in time, he can use it for whatever he wants. It doesn't mean you can't take it out at any point in this process. Our goal is just to show you that if you had other assets and you weren't going to use your line of credit immediately, this is an excellent way to get that money growing higher than you would potentially in a CD or other types of investments. We do have a gentleman right now. His name is Ronaldo, and we're working with his family on getting them a reverse mortgage. And unfortunately, he requires around the clock in-home care. And he's lived in his home for 50 years and he wants to age in place. He doesn't want to go to a nursing home. And his family doesn't want to have him have to go through that as well. And they've been paying the monthly medical expenses for him. And it's really hurting them. So we recommended that they obtain a reverse mortgage on his house, tap into that equity, and now he can cover his own home health care expenses without that financial burden on his family. His decision to use the reverse mortgage to fund his long-term care was a smart and considerate move. It not only provides him with the ability to age in place while accessing the necessary funds he needs for his care, but it freed up money and ensured that his loved ones can maintain their financial stability as well. So this was a tremendous win-win for his family. Okay, so I'm going to talk about the common myths. There's some myths about reverse mortgages from the past when prior to FHA taking over this type of mortgage and instituting a lot of awesome changes and improvements to the program. One of them is the lender or the government will own my home. Well, actually, homeowners retain title and ownership and can choose to sell their home at any time. They must simply retain the home as their principal residence, stay current on taxes, homeowners insurance, and keep the property in good condition. My heirs will owe more than the home is worth. Well, this loan has a non-recourse feature, and that means you will never owe more than what the home can be sold for. And the FHA insurance guarantees this for the life of the loan. Reverse mortgages are expensive. Reverse mortgages are no more expensive than your regular forward traditional mortgages, except for the upfront FHA insurance premium, which is approximately 2%. But this insurance is what keeps the homeowner from having to make a monthly payment, from worrying about having to sell the home for more than it is actually worth. And it also enables that potential line of credit. I will have nothing left to give my kids. I'm eating up my entire equity. A reverse mortgage typically allows homeowners to access their home equity, but not all of it. You can see very clearly from all of the examples, no one was taking more than 50% equity out of their home. This is designed to ensure that there is still equity left in the home, and with reasonable appreciation, home values over time, it's possible that the remaining equity could grow where your heirs would have a nice inheritance at the end. Reverse mortgages are last resort options, and they're only for those people who are desperate. Well, this is just not true. Need-based borrowers actually represent the smallest percentage of reverse mortgage lending today. In fact, most seniors are looking for ways to convert their home equity into usable, viable income, no matter what their economic status. And last, reverse mortgages are a scam. Well, because seniors are a protected class, reverse mortgages are monitored by FHA, HUD, the CFPB, the FTC, and many, many other government agencies. But the best evidence of a reverse mortgage's value is the surveys that come back showing that nearly 90% of reverse mortgage consumers are satisfied or highly satisfied with their decision to take a reverse mortgage. Boom, those myths are gone. Now, the process of getting a flex payment mortgage. So Michelle mentioned earlier, the income documentation it's usually streamlined. You don't usually have to make nearly as much money as you do because there is no monthly payment. You do have to afford the ongoing costs of your property taxes, your homeowner's insurance, dues, and general maintenance on the property. And the credit review focuses more on your payment history rather than the actual score. There's not really a minimum FICO score requirement on this program. You have to have a full FHA appraisal. And in those instances where that borrower may not be able to pay their own taxes or insurance, a reserve account, kind of similar to an impound or an escrow account that you have on a traditional mortgage, might be considered to cover future property taxes and homeowners insurance for the borrower. This is not super common, but it is an option if needed. How do we determine the loan amount? Well, we talked a bit about this already. It's the age of the youngest borrower on the loan, the value of the property, and the current interest rates. The program is designed, as it says, to provide a high probability of future home equity remaining at a comfortable level through your life expectancy. Generally speaking, you can usually get somewhere between 30% to 60% of your home's appraised value. 30% when you're younger, 60% when you're in your late 90s. What's the FHA appraisal? So this is required because FHA is looking for health, safety, and structural issues like, is there smoke detectors? Is the hot water heater strapped? Are there any visible leaks? They want to know that the property is in good general condition. If the appraiser finds repairs, they must verify that they were completed before the closing of the escrow. Payments for the repairs are your responsibility, but the reverse mortgage might be able to be used depending on the level of the repairs as part of some of the money that you pull out. And on rare occasions, FHA might require a second appraisal on a super complicated property. And in that scenario, they would use the lower of the two appraisals. We mentioned before that reverse mortgages, flex payment mortgages require mandatory HUD counseling. Since seniors, again, are a protected class, the counseling is required to protect the borrowers and to make sure that they understand how the loan works and to confirm that they're not being taken advantage of. There are a lot of elder scams out there that, can really trip somebody up, and getting a reverse mortgage from a reputable lender and going through the HUD counseling can ensure that someone is not being scammed. The counselor explains the process, helps determine if the reverse is truly your best option. It lasts 30 to 60 minutes. It can be over the phone. And this is an independent counselor. This isn't Amy and Michelle having a conversation with you. This is someone by HUD. We give you a list. You pick them. You pay for that. And they meet with you and just talk objectively about the program with you. They encourage you to bring family, trusted advisors, friends, anybody that you want to attend that session with you. They then give you a certificate, which is the first step in proceeding with a reverse mortgage. So, what happens when the loan comes due? So, the loan is due when you pass away, move out, or sell the home. And again, the last surviving borrower passes away. Typically, the loan is repaid by the sale of the home. And if the value of the home is more than what is owed, the estate retains that extra equity. If the heirs wish to keep the home, they can do so by just paying off the loan either at the lesser amount of what's owed, the loan balance, or 95% of the appraised home value, whichever is less. This flex payment mortgage, again, is a non recourse loan, which is what enables that above paragraph. This means the borrower or the estate will never repay more than the loan balance or the value of the home, whichever is less. And because we feel so strongly about making sure people understand what non-recourse loans mean, we're going to say it again. FHA-backed reverse mortgages are non-recourse, meaning the borrowers have no personal responsibility to repay the loan other than the home itself being the sole source of repayment. And on those rare occasions where a homeowner might outlive their equity, say you're one of those people that makes it to 110 and you're living there and you're using your line of credit and you're pulling it all out, and now you're upside down, meaning the loan balance exceeds the value of the home. While living, you, the borrower, may continue to reside in the property, assuming you have not defaulted, meaning you are paying your taxes, your insurance on a timely basis. And after you pass away, neither the lender nor FHA can demand repayment of any shortfall from your heirs or the estate. And the heirs can keep your house again and remove the flex payment mortgage lien on the property by paying 95% of its appraised value, or execute a deed in lieu of foreclosure if they're upside down and just turn the property back over to the lender. Okay, important information. This is a disclaimer that we're required to let everybody know at the end of the reverse loan term, some or all of the property's equity won't belong to the borrower, and they may need to sell or transfer the property to repay the proceeds of the reverse mortgage. Guild will add the applicable reverse mortgage origination fee, the mortgage insurance that we talked about, closing costs, servicing fees to the balance of the loan, which will grow along with interest over time. Interest is not tax deductible until all or part of the loan is repaid. Failing to pay your taxes, your insurance, or maintaining the property might subject the property to a tax lien or foreclosure or other encumbrances, since the borrower still retains the title. So, in summary, why choose a flex payment mortgage? For a multitude of reasons: to access cash and pay off your current mortgage, to extend the life of your portfolio by using it as a retirement strategy, cash flow, just extra money coming in every single month, set up on a term or a tenure, improve my yield, shift low yield accounts to a line of credit where I can now be earning more than, say, that low CD. Just reserves for the future. Long-term care costs are a huge concern for people. This is a great strategy for pulling that money out now and letting it grow until you need it. Or purchasing a home, something most people don't know you can use a flex mortgage for. And last, Guild Mortgage. Why? So Guild Mortgage decided last year to get into the reverse mortgage business because there's a lot of not great companies out there handling this in a professional manner. And we believe strongly that seniors deserve to have their own loan, just like first-time home buyers have all their own loans. This is really the only loan designed for seniors. So they purchased a company called Cherry Creek Mortgage, was a top 5 reverse mortgage company in the United States, and they want to do it right. We have exceptional service, deep expertise. We have great knowledge on this program, local support, email support, phone support. You can reach Michelle and Amy when you have a reverse mortgage. And then long-term relationships. We want to be your lender for life, whether it's your first house or hopefully your last house. So with that, are there any questions?
One thing
Michelle?
I want to point out too is that we have a great booklet that we supply to each and every client that we counsel on this particular program because we're so confident that, in this product, I should say, but we want you to understand it. And it's really a skinny little book that kind of goes over terminology. We have one for those that are wanting to purchase, one for those that are wanting to do a refinance to gain the equity out of their home. And then we also have one for financial planners. So, for anybody that has a financial planner that they may want to share it with, please reach out to us, send us a quick text or message us, and we'll be glad to get one out to you.
So, Michelle, we have a question. How do you and I get paid? Marcia, way to be looking out for us.
Well, that's
I'll
a
let
good
you address
one.
that.
Yeah, so there the payment for us, we are paid, when the loan closes. And we have a compensation agreement that's in place ahead of time based on, percentage of the loan. We have that preset. So there's no out-of-pocket due from the borrower to pay us. The only out-of-pocket expense you have on this loan is for the appraisal and the HUD counseling. And then we are paid by Guild Mortgage once your loan closes.
And your closing costs and the FHA premium, that is wrapped into the loan. So even if you got a line of credit and you chose to take no money, you will still have a small balance on your reverse mortgage to cover your closing costs and uh, the service fees that are included up front. And then those will continue to grow over time as the interest rate accumulates. Um, Michelle, can I put my kids on the house?
Oh gosh, yes, you can, Amy. You can put your kids on the house, meaning deeding them onto title. Although I really don't recommend that. And let me just give you a quick story. Recently, a client from San Diego, and just a quick note too, Amy and I are both licensed in California and Nevada. So we can
And
help you in
Oregon.
your state. And Amy's licensed in Oregon, and I'll be licensed in Texas and Idaho pretty soon. So, so I recently had a client from San Diego. She's 91, and her funds are getting a little tight, especially with the higher cost of living. And her HOAs went up for her association, and she wanted to a reverse mortgage. Well, about 5 years ago, she had put her son on title to her home, thinking that, if something ever happens to her, it's just an easy transition and he gets the house. Well, not so fast because her son is a small business owner and evidently he'd been naughty and hadn't been paying his IRS taxes for a few years. And the IRS put a $150,000 tax lien against Mama's home. So now she could not access those funds because one thing to remember is if there is a lien against that property, which she didn't have a mortgage, but now she has a lien from the IRS, they take first precedence. And the only way to do any type of loan, whether it's a flex payment mortgage or even a traditional mortgage, is the IRS would have to be paid off. Well, that wasn't going to happen. And Mom wasn't able to get her mortgage. There's other great vehicles to ensure that your heirs get proper title to your home. Amy and I highly recommend doing some type of revocable trust. And, that would be a question to talk to your attorney about. But just by adding a child onto a title to a property does not insure you against probate. That is one big myth that, people seem to think that, oh, I'm just going to put my kid on title. That property will still go through probate. So just keep that in mind. Probate's expensive and it takes, 9 months to 12 months to get through.
Marcia had another question. What will happen if something terrible happens to the US economy and the value of our home collapses, drops significantly? Tiffany, do you mind scrolling back on a couple of those slides? Marcia, this is where that non-recourse really comes into play because that could happen. I mean, look at 2008, 2009. So because it is a non-recourse loan, on those rare occasions where you outlive the equity or the loan balance exceeds the value of the home. So let's say the home is worth 500,000 today, you have a line of credit on that property, and then it drops. The home values drop to 300,000. Now you're technically upside down. Because this is a non-recourse loan, you do not owe any more than the actual value of the home or the loan amount, whichever is less. So if the loan amount has grown to 500,000, but the appraised value is 300,000, your heirs owe the 300,000. And if they can't refinance it and don't want to keep the property and obviously cannot sell it for anything more, then they could just execute a deed in lieu of foreclosure and the bank would take it back. And that is all that can satisfy the debt on that property.
One thing I just want to point out really quickly. So, Marshall, let's just say that, the economy collapsed, the values went down, but let's say you hadn't used your line of credit. You're not penalized if that happens. You
Right.
still have 100% access to your original line of credit. You don't get it taken away.
And that leads to another question that has come up in the past is why wouldn't I just do a HELOC, a home equity line of credit, or just a cash out refinance? Well, if you own your home free and clear, those are absolutely options that people can use. A home equity line of credit would, of course, require a monthly payment, whereas a flex payment mortgage or reverse mortgage does not. So that's one of the biggest differences. But a home equity line of credit also is interest only for the first 10 years, and then it becomes an amortized payment after that. But the bank can at any time freeze that line of credit or close that line of credit. On a reverse mortgage, as Michelle mentioned, that line of credit, whether the value of your home has decreased or not, is still available to you. You can still withdraw those funds, even if you outlive the value of that home itself or it becomes upside down. We have another
I
one.
did see, Amy, that Marcia had one other question. Are there current borrowers we could chat with about their experience with the
Oh,
flex mortgages? You know what? I have several that have told me if we ever want to use them as, a testimonial voice, that certainly they would. One of them did the loan strictly to pay off her existing mortgage. She was faced with a loss of income when her husband passed away, and that was a lifesaver for her. The other person did it strictly for a line of credit for long needed home improvements that she couldn't fund without that. And then the other one was the
would
lady
be
that,
Kathy, right? The
yeah,
self-employed borrower.
right.
Yeah.
So absolutely, if you want to be able, I'll get permission from them and a phone number and let you know.
And one other question, Michelle, how long do my kids have to sell the house after I pass away?
That's a really great question. So technically, the reverse mortgage guidelines are 6 months. That means that you have, basically, if someone passes away, their heirs need to notify the mortgage company that that has occurred, and then you start the clock ticking for the disposition of that property. But we also know that sometimes things don't happen that quickly. Maybe the heirs live in a different area. Maybe there's, multiple heirs and it's going to take some time. So the mortgage company is allowed to grant up to two extensions for a total of 1 year. But one thing to remember is if the line's been used, that interest is accumulating. So that's kind of why they want you to get it handled sooner rather than later. So it just, you have more access to the funds or the equity in the home.
Right. Doesn't keep accruing, so you're
Doesn't
eating up the
accumulate.
equity on it. Yeah.
Right.
And then at the age of a spouse also popped up. So we had talked about how the reverse mortgage is based on the youngest member in the household. So someone who is 62, they're going to be more limited on how much they can pull out of the property, more in that 30% range, 30 to 35, versus someone who might be 90, who would have a much higher access to his line of equity. That doesn't mean that uh, you can't do the reverse mortgage on the older person's age, but we wouldn't recommend that. And why is that, Michelle?
So what happens is if let's just say, there's an 81-year-old married to a 65-year-old. So yes, if you do a reverse mortgage for an 81-year-old, they're going to get quite a bit more access to a much larger line of credit. The problem is if the wife isn't on the loan, when he passes away, then she would be faced with having to refinance that home. And, because I've had this conversation real just recently with a client, and the realities of that were she had very limited income. She would not be able to afford to keep the home if, to refinance it on her own if anything happened to him. So, yes, it can be done, but you really have to think about what that long term looks like if that spouse isn't on the loan, because, with both of them on the loan, she doesn't have to leave that house until she either sells it or she
Right.
passes away.
Right.
So
It's
she's
the
not
surviving spouse.
the surviving spouse, and she
Mhm,
never has to make a payment.
mhm. And then Marcia jumped in again and said, how does a mortgage company make their money? So, like on any mortgage, the mortgage company has their fees, their lender fees, processing, underwriting, and then a bunch of third party fees, et cetera, et cetera. And so that is how the mortgage company, just like any loan on any forward mortgage, we have those fees in place. That becomes part of that balance in your account. It is financed into your loan. That doesn't mean you can't pay those off later and zero, get that back down to a much lower amount if you want to. But because those closing costs are included inside of the loan, it might feel like we're not getting paid, but we're getting paid because those fees are getting dispersed back to us. And out of that money is how Guild then pays Michelle and Amy.
And then
And that's how it
also,
works on any loan.
right, and then because we service those loans, because
Good point.
this is not to say that Guild could not sell the servicing, but we do retain um, right now on any FHA reverse mortgages, we do retain 100% of our servicing. So there's some servicing income that comes in as borrowers are advancing the lines because there's a margin on that loan. Remember, it's the index plus the margin. So mortgage companies are paid in two different ways.
All right. Does anyone else
Right.
have any other questions? Those were great ones.
These were great ones.
Yeah. Well, we just want to thank you and let you know that if you have more questions or you'd like the booklet, just shoot us an email or a text or a phone call. We're happy to meet with you. This isn't an immediate decision for most people. There's multiple conversations. We understand that, and we're completely available to have any in-depth conversations or do a one-on-one where we actually do a proposal for you and your actual circumstances.
Yeah, thanks so much, everyone. We really appreciate your attendance today, and we look forward to being able to share more information with you.